Hey guys, it's Max. Thanks for joining my channel. I appreciate y'all for being here on this cold and windy and dreary and drizzly day here in Austin. 48 degrees. Not a typical spring day in Texas for sure. All right, today we're going to check out the new formulation, the new prospectus, the new proposed changes in the Defiance funds. What I would call these their flagship funds. They filed for a change to WDTE, QQQY, and IWMY. We're going to take a look at the strategy and see what it is. Okay, here they have it. Defiance, NASDAQ 100, target 30 income, QQQY. So the symbol's staying the same, but they're changing the name to the target 30. So that tells you right there they're going to go for a 30% yield. They have some target 20 funds right now, SPY-T and QQT. I'm assuming these will be just like those, except a 30% yield. Let's keep reading and see. The expense ratio is the same. That's true. The investment objectives are the same. Primary objective, income. Secondary objective is to seek exposure to the performance of the NASDAQ 100 index. Very standard. Here's the only thing. I read this so you guys don't have to. The only thing that really different was the fund's investment approach, designed to generate income through option premium, of course, derived from selling index call spreads, which would be the primary driver for the fund's yield. The way the old fund did it is they sold puts. They didn't sell call spreads. This company is actually going to sell call spreads, and they're actually going to own either the SPY or the IVV. They're going to own the underlying and then sell a call spread on top of it. Okay, now the risk and reward should be substantially the same. A naked put and a covered call are very similar strategies as far as risk and reward goes. We'll get into the option simulator right now and look at it, because I think that's really the only difference. So just we're going to demonstrate this with SPY. I think Jay will probably use SPY shares, but SPX options. But I'm just going to keep it simple with SPY because that's how people understand it. But for instance, this might have been a trade the old fund might have done. They might have sold the 509 put for Monday. Now, the SPY closed at 506. Okay, so they sell a slightly in the money put. Jay's told me before about a 60 delta. This one right here happens to be a 55 delta. But for the sake of my demonstration, I just wanted to show that that's what the old fund did. Now, look at the risk on this. Per contract is $50,000, which is the value of the SPY, the entire value of the SPY. Okay, well, let's look at what the new fund's going to do. The new fund up here is going to have 100 shares for each option they sell. They're going to have for each spread they sell, I should say. They're going to have 100 shares of SPY. There we have the SPY right there at 505.54. But instead of selling the put and having no shares, they're going to have shares plus sell a call, but it's going to put them in the same situation. Look at the max loss, $49,000. Because what can happen if you have shares of anything? It can go to zero. Okay. Well, what can happen if you sell a put on anything? If the shares go to zero, it's the same thing. Selling the puts is synthetically equivalent to the covered call. They both also have capped upside. Okay, well, anyway, so this is the way that this is the covered call, but this isn't what the new fund filed for. The new fund went a step further and filed for a structure that looks like this. They filed for a call spread. So they're going to own shares of stock. They're going to sell the 509 call, and then they're going to go a certain distance above there and buy another call. Okay, and the way they're going to set the distance, look over here where it says net credit. Right here, we have the strikes are spread apart by 10 points. If I move the strikes closer, it makes the credit go down, but it also makes the profit loss have more upside. What Jay's traders do is they set the width of the spread exactly where they need to be, and not 1 penny more narrow and not 1 penny more wide than to get the 30% yield. And the reason they do that is because you want this to be as narrow as a spread as possible. If they could get a 30% yield by selling the 509 and buying the 510, they would do that all day long. But they can only sell the 509 for $6.59, then they buy the 510 for $6.07. They only make 50 cents, right? $50 isn't worth doing it. They do have pretty much the same upside as stock. But what they'll do is they'll put on a spread, something like this, but they'll set the credit where it equals exactly what they need to make. But the point is leaving themselves as much upside as possible. So this is the old way of doing it. Just selling a put, being totally capped. Then this is a different way of doing it. Just selling a covered call. This is the way QYLD does it, being totally capped. I just wanted to show for comparisons, and this is the new way of doing it. Okay, now I want you to look then the new way is superior, in my opinion. We're getting ready to back test it and find out if my opinion is correct or not, according to the back tester. So now I want you to check out this screen. I overlaid the strategy. The white line is the call spread strategy, and the red and green line is the old strategy. So you can see in a big up move, the call spread strategy is far superior. You get upside just like stock. And yeah, down moves are bad for sure, but a down move in the old strategy is just as bad. There's that the downside's substantially the same, but the upside is a lot different in favor of the new strategy. And obviously you can tell I'm excited about the new strategy. Okay, so let's try to back this up with some facts. And so I went back and I tested the new strategy in the Tasty Trade back tester. And I went back as far as the back tester will go. Let me show you what I came up with. Results going back is to like 2013. And this is the call spread strategy, the covered call spread. So the new formulation, look at this. This outperformed buy and hold by a little bit. Buy and hold would have made $349,000. This strategy made $363,000. The strategy made 295% total return since 2013, where buy and hold made 284% total return. It outperformed buy and hold, and this is while paying a 30% yield. Or I should say, while having the strikes of the spread set at the proper distance to pay a theoretical 30% yield. So this is a big deal to me. The fact that it can outperform in the back tester. And we look at it another way here. There was the amount of trades. So over in all these years, it had 708 trades. 60% of these covered call spreads were profitable. 39%, 40% were unprofitable. Average return per trade is half a point. Average days in trade says 2, but it's 1. Average buying power. Okay, but average premium. So in this way of doing it makes $1,000 a day. And according to the back tester, over the course of all these years, they held on to about a third of it. Anyway, so the back test is in totally encouraging, and I am enthusiastic about it. So let's see what else we could look at. Let's maybe test it over the past. Let's test it since inception of QQQY. Let's get in the Tasty Trade back tester and look at a shorter term test of the new way and the old way. I think that might be interesting. Here's, I went back to the date that these funds were incepted, and I looked at a call spread strategy. The Tasty Trade backtester doesn't let you use shares, but I simulated the shares and then did a covered call spread strategy, and this did extremely well. Yes, it had a higher drawdown than buy and hold, but it outperformed buy and hold. So that's pretty good. It outperformed it not by a little bit, but by $10,000, by about 30%. It returned 30%, where buy and hold returned 20%. It was about 1/3 extra alpha, let's say. Average profit per trade was $192. Okay, so now just for comparison purposes, I'm going to run the fully capped back test. where we're selling the fully capped and we're going to switch this to a put. And then we don't need the other legs because we don't have stock and we don't have a spread. We're just going to sell one put. That's all we need. So now let's run this over the same time period and for comparison purposes. Now we know how this did in real life because we can look at the since inception return, Defiance since inception return. All right, so since inception, the fully capped strategy is down 3%. Okay. Max drawdown was more, but max drawdown was more on the other strategy too. We can handle max drawdown. The drawdown wasn't our problem. It was we didn't make enough during the good times on the old strategy because we were fully capped. The drawdowns are roughly the same. So this strategy was an underperformer. So does Jay and them have back testers? This strategy was better this strategy worked fine for a bull market. For a bear market, the spread strategy will work better. Well, why is that? Well, the reason why that is because the spread strategy, and let's pull it up here so I can talk about it. The spread strategy has partially uncapped upside. So here's the two strategies next to each other right here. So what happens in a bear market? What the market goes down a lot? Okay, goes down a lot. Well, both strategies lose about the same. Okay, so but what else happens in a bear market? You have face ripping bullish days. In 2020, we had a 9% up day, and I think a 6% and a 5%. And in 2022, we had face ripping up days too. Volatility expands on both sides, and that's something some traders miss. The credit call spread idea is a lot better idea in a bear market because it can monetize the quick bounce backs. And to a degree that a fund that's fully capped, like a fund that just sells a naked put, like Defiance did before, or even a fund even a fund that just sells calls, but they sell calls on the whole portfolio, they're totally capped, and there's nothing wrong with those types of funds. But it just you have to know what you're buying. In my opinion, the new formulation's going to work much better, and I'm excited about it. When I ran the long-term back test, I've only had one other strategy that's beat buy and hold since inception, and I've talked about that before. That's my GOAT strategy, and I'm trying to get a fund manager to put that in an ETF. But other than this is the best strategy I've ever tested, other than the GOAT strategy. So this is something else. So I'm really excited about this. We'll see what happens. We'll see if it gets approved. Well, and it will, but we'll see if they change it between now and then. I'll probably have Jay on around the time that this fund comes out. He was on in January. By the time this fund comes out, it'll probably be time to have him on again. So let's just do that. We'll get him on to talk about this. I really wanted to get him on to talk about the lightning spread. You guys may have forgotten about the lightning spread. The lightning spread was that fund that caused all the controversy because it was a daily payer. I emailed Jay and he said it wasn't going to be a daily. I swear to God, he told me that. I have the email. Told me it wasn't going to be a daily payer, but then, a week later, all of a sudden, he told me to read the prospectus or whatever. But anyway, it is going to be a daily payer. But that's not why I'm excited about it. I'm excited about it because it does an even different strategy than this that is somewhat similar to the GOAT spread and should have a lot of upside also. So I think there's a lot of upside on the table for these high yield funds. Now, I don't know if there's a lot of upside for the market. It's kind of a rough time for the market, but as the market bounces back, I really believe these Defiance funds will be uniquely positioned to take advantage of it. I would say even more so than Round Hill. Round Hill is also a good bull market fund that a lot of people like. Round Hill takes advantage of gaps up overnight. Now, gaps up overnight happen a lot in a bull market. What I think the Defiance fund has the advantage over, because they're trying to take advantage of just not so much gaps overnight, but just big up days in general. It could be a gap overnight that turns into a big up day, but they're just trying to monetize the big up day. And that's the thing. Big up days are what happens in bear markets. I don't think you get a lot of gap up overnights in bear markets. Maybe some of them, that happens more in bull markets, but you do get a lot of rip roaring short covering rallies. This strategy takes advantage of that. It lets you monetize the short covering rallies is where I was going with that. All right, guys. Well, I appreciate you being here. I'm going to let you go. It's a beautiful Sunday. Not really, but I'm going to put on my jacket and go outside and hang out with Mr. Jax. All right, guys. I appreciate y'all, and I hope you have a good day.